Well, welcome to CapEd's podcast. This is a very late hitting December episode. How you doing, Jamie?
I'm doing good. Just watching the snowfall right now.
Right? Yeah, it's finally really winter. It feels like it even. White Christmas came late, but it finally showed up. So we have a really good interview this month. We have Tyler Harris from our brand engagement team interviewing Jeremy Sankwich, who is our VP of lending. And they have some excellent information about credit card usage and credit scores and basically how those two things work together. What did you think of it?
Yeah, it's a great episode, especially after the holidays. They talk about your credit card usage and just kind of helping yourself kind of get that debt paid down. Super helpful information, stuff I know I took away from and I hope to be able to use and kind of help myself out as well, especially after the holidays and everything.
Yeah. There was a lot of things where, even though it's a pretty short episode, only about 20 minutes, there it is just packed with really good information. So I know, this is just part of our continuing effort to educate our members and the public about, responsible fiscal, responsibility and practices. And this fits perfectly with that.
Yeah, we want everyone to be financially successful and have that financial freedom, which they speak on all the time, especially throughout this podcast episode. If you need a visual reference, we actually have a post on our social media accounts that reference almost the same thing that Tyler brings up about that debt consolidation. So we definitely recommend checking it out.
Excellent. Yeah. Great reminder on that. So without any further ado, let's jump into it. Thanks, Jamie.
Welcome.
Hi, everybody. My name is Tyler. I'm the brand engagement specialist with CapEd, and I'm here with Jeremy Sankwich, who's our VP of consumer lending here with CapEd. And we're here to talk about consolidating loans and spending with our credit cards after the holidays. Because I know after the holidays, we kind of spend more than we can afford, and it's pretty common for us to use a lot of our credit card usage. How are you, Jeremy?
I'm doing well. How are you?
I'm doing pretty good. So I know after the holidays, of course, we use our credit cards, and I kind of wanted to go over what CapEd can offer our members to help with that and help with their credit score and kind of lessen the burden of having so much debt racked up after Christmas.
Of course.
So the first thing I kind of wanted to go over, what would you advise someone to do if they find they have spent a lot on multiple credit cards in a short period of time? What would you advise?
Well, that's a good question, and it's very common during this time of year, like you just said. The first thing that we start with here is we always start with the education side. And because everyone's different, everyone has a different starting point, everyone has a different and unique situation. And there's never a one size fits all principle that you can just apply to everybody's situation. And when we talk about education, what we do is we try to align where the credit score and the credit reports align with personal finance principles. If we only talk about one or only talk about the other, we're going to miss some of those key points that will really help people out, especially in this situation if they've spent a lot of money on their credit cards and they kind of have that January hangover after the holidays when it comes to their finances. The first principle that we align here between the credit card spending and how that aligns with their personal finance and their credit reports is just to start with the principle that paying other people less money is always a good thing. And so that might mean getting out of debt, or that might be consolidating debt into lower interest rate loans so that we can get out of debt quicker and spend less money in the process on interest. So that's kind of where we generally begin with in those conversations with our borrowers, especially in January when it's kind of that debt consolidation season, if you will.
Right. And I know when you go shopping, those retailers, they kind of dangle those credit card pre-qualification offers to you, and they're pretty tempting. I've gotten a lot of offers myself, just out and about doing day-to-day things. When that happens and people say yes to multiple credit cards like that, is that a good thing or a bad thing?
Well, it's when we talk about let's answer that question with each of these lanes, the personal finance lane and then the credit report lane, because again, they're very much related. From the credit report and the credit score lane, it's not a good thing, because each time that you accept one of those offers or you apply to see what you're approved for, you're going to have your credit report have a hard inquiry on it. The credit bureaus look at those as you are applying for credit. Therefore, you are seeking out additional ways to spend. And especially if it's in a credit card, those will impact your credit multiple times. Each time that you apply for a credit card, you're going to receive a hard inquiry and it's going to impact your score. If you are shopping at 3 different stores during a week for Christmas and each one of those stores you accepted that offer, you're going to see your credit score deteriorate in that first week just because of applying for those cards. That doesn't even take into account what you spend on them.
Right.
So that's the first principle there, is on the credit report side. On the personal finance side, it's always best to spend what you have. So saving up your money, preparing for your Christmas shopping season in October, November, or even sooner, if depends on our income situation with each family. You may need to start towards the beginning of the year, setting money aside so that you have that money to spend as you roll into the Christmas season. If you do it that way, then you could be more strategic in how you shop. You can look for better deals, and you could spend your cash that you have that you've set aside for your Christmas shopping. Having that disciplined approach will allow you to spend less, look for those good deals, be prepared for them, and not have to worry and rely on those options, those too good to be true options, buy now, pay later, because there's always going to be a catch at the end of that. And is that present worth it? Is that gift worth it? Is that experience worth it? Or is it better to just be prepared and set your money aside budget and spend the money that you've saved up? Always a better principle on the personal finance side. And at the end of the day, your credit score is not going to take a big dip, so that the following year you're going to be recovering from that.
Awesome. Thank you, Jeremy. Those are awesome points. And even if you find yourself in a tough spot and you've racked up debt with multiple cards or with a personal loan or something like that, I do know there's a technique that you can use called a snowball effect, where if you are in the situation, then it's easier to focus on the card that you owe the less amount on and just kind of focus on paying that off first with as much as you can. And then once you pay that off, you can go up to your next card with the next amount, and then pay that off and just keep going as best as you can. And in that term, the snowball effect, it just kind of snowballs until you successfully pay off your debts. Is that smart?
It is, yeah. There's multiple different strategies for getting out of debt. So in that situation where there's a borrower who has 3, 4, 5 credit cards with balances on them and they're trying to get themselves out from that debt, there's multiple strategies. I would say that there's not one that is predominantly better than all the rest. It really depends on the situation and what's available to that borrower. The snowball effect is definitely one of the more common ones, where we focus on the lowest balance first so that we can get that early success and then work our way towards the larger balances. And that's a really good strategy. Another strategy is really focusing on that. How do I just simply, in the process of getting out of debt, do I help recover my score quicker? And how do I do this in a process that allows me to pay other people less money? So what's the overall interest I'm going to spend during this process of getting out of debt? And that's where we come into a debt consolidation loan, and where we start aligning those principles with a borrower's credit report and their credit score and their personal finance. If we look at how a credit score is determined when we consolidate a loan, consolidate multiple loans like credit cards, which are loans. If we consolidate that debt into a personal unsecured loan, that is what in lending we call a term loan or a fully amortized loan. And the credit bureaus will score those loans higher than they score credit cards. And so if we were to consolidate the credit cards into a single loan, this isn't true every single time, but most often those minimum payments added up on 4 or 5 cards when they get consolidated into that unsecured personal loan, there's three
Mhm.
principles that take place here. First is that the overall payment is less. So that allows the borrower to have less of their monthly budget going towards servicing debt. If the goal here is to get out of debt, then we want to be aggressive with that payment, and we want to make sure we're applying all of our discretionary income towards getting out of that debt. And so that term loan will have that credit score effect where it's going to help them recover their credit score quicker. It'll be a fixed payment loan, so there's not going to be a variation in the payment, and the interest rate's going to be lower on it than on the credit card. So we're paying less interest during this process of getting out of debt. And then third is we know we have that in sight. If it's a 48-month term loan and we're aggressive on it, and we could pay it off in say 6 months, 9 months, 15 months, either way, we're not going into further debt with the credit cards, but instead we're seeing that loan pay down over time with less interest, with less of our money going towards paying those financial institutions, those banks, those credit card companies.
Yeah.
That's the first half of that strategy. The second half of it is, what do you do with those cards that we just close or that we just paid off with that loan? This is where we want to be strategic. What I always tell our borrowers is when we're consolidating loans, consolidating credit cards, we generally require them to be closed. What we don't want to do is allow a borrower to consolidate their 4 or 5 credit cards into a new personal loan so that we have that good financial strategy put in place, but then they just turn around and go and spend money on those credit cards again.
Right.
Now we have twice the debt if they rack those back up. And so what we do is we force those to be closed. They have to be closed, and that way that we're consolidating the debt and we're not getting back into that vicious cycle. But what we do is we generally advise that we keep one of them open. And here's why. It's not so that they can keep a balance or anything else. It's one of the ways that a credit score is determined, in a pretty significant factor. It's about 15% of the credit scoring model is the average age of credit. So if we look at 4 or 5 credit cards, what we want to do is find the one that has been open the longest.
Mhm.
Most people opened a credit card when they were 19, 20, 21 years old, and a lot of them still have that card open. That's the card that you want to protect. That's your length of history. That is helping your score be strong and have a depth of history. You want to protect that card. You don't want to keep a balance on it. You don't want to continue to use it because it has to be at 33% usage. That's a myth that the credit card companies love, because it means that you stay in debt with them and pay them interest. You want to keep that at a zero balance, but you want to keep it open and active. That way you have that depth of history and that you protect your average length of history. And then you close the cards that have been opened the most recent. By closing the youngest cards and keeping your oldest card open and active, what you're effectively doing is you're recalibrating the average length of history to be a larger number. And that's going to help your score, if not go up, at least stay strong and have a depth of history. Most often when we do these debt consolidation loans, we save people money on their payments. We save them in interest. We help them get out of debt quicker, and we'll see their score recover 20, 30. I've seen 120 points. It was 7, 8 cards, but you have a big lift in your credit score when we do this. And I know that there's some folks that say credit scores don't matter, that you should be proud of having no score. But the reality is, applying for a lease at an apartment complex, employers do background checks, including credit reports, applying for an auto loan, applying for a mortgage. All of these require good credit scores. And so why not ensure that you're not only debt-free, you're not only good personal finance principles, and we're budgeting and we're using our money that we've earned to pay for stuff instead of going into debt to pay for it, but at the same time have a strong credit score for all of those scenarios where background checks or credit scores are used, that will help you be front in the line for the lease application, be front in the line for your job application during the background checks, etc.
Wow, that's amazing information. I know when you were talking about credit cards and keeping your oldest card open, just a side note for the listeners, I followed that as well. I opened up a card when I was 18, And to this day, I still have that same card, and it's kind of bittersweet because the interest on it, I'm not going to lie, is almost 30%, I think, but I never use it, but it's my oldest card, so I just keep it hidden away, like you were saying. So it's a bittersweet thing. Like, yeah, you don't want to have that credit card, but you really do if it's your oldest card, you know?
Yeah, and just because you have a credit card doesn't mean that it's a bad thing. It's just, it's
Right.
how do we use them? What is our financial behavior?
Yeah.
And how does that impact what we're talking about here, which is, credit card debt and not being in debt. And that's one of the things as a credit union that I think sets credit unions apart is we're not interested in ensuring our borrowers stay in debt with us. What we're interested in is making sure that they are on their own personal path to not just financial freedom, but whatever it is their financial goals are.
Yeah.
And we're here to educate and help them through that without a profit motive.
Exactly. And that kind of goes into CapEd and what we offer. We offer a lot of low interest credit cards and consolidation loans like you were talking about. And we want to see people succeed and be financially free. And we're here to support members in any way we can. Along with that, we have our online banking, and on there it shows your credit score, and you can see it whenever you want to. Whenever you log in, you can go in and see what your credit score is through Savvy Money. And you can actually go in there and manipulate your score by creating scenarios of adding debt or subtracting debt, adding different types of loans, and seeing what your score will project to be if you were to add or subtract debts like that. So it's an amazing tool to use to figure out what the best thing for each member is. So that's awesome that you shared all of that. So thank you.
Yeah, what you're describing is called the score simulator. And one of the things when we teach our classes, whether it's I've taught first-time home buyer classes, first-time auto buyer classes, we always touch on credit scores and principles. And one of the things that I find to be one of the biggest myths that people have bought into over the years is that I have to keep a balance on my credit card in order to have my score, be strong.
Yeah.
And that's actually the exact opposite of the truth. The truth is that the second most important factor for your score is what we call, this is an industry jargon term, is the utilization ratio. It's the percentage of the balances of your credit cards divided by the overall available limit. And that utilization ratio, the higher it is, the lower your score will be. And the lower that utilization ratio is, right down to 0%, the higher your score will be. And so by keeping your credit cards at a zero balance, you're maximizing your credit score. If you try to keep a 25% ratio, usage ratio, utilization ratio, these terms are generally what's used out there in the industry. That is a myth that is a little bit less common now with the prevalence of Credit Karma, Savvy Money, really these kind of the financial tech type user interface companies have began to put the credit score front and center with the consumer, so they have exposure to it, not just on a once a year basis, not just when they apply for credit, but literally on a daily basis. And to go even a step further, what Savvy Money, which is a program you just mentioned that's available to our members for free behind online banking, is that you have what's called a score simulator, and you can test this out. Go in your score simulator if you have credit card debt and just say that you're going to pay off your credit card debt to zero balances, and watch what will happen to your score. It will go up. Even if you only have, say, a $300 balance on your credit card, just paying that $300 balance off, your score will go up. All other things remaining equal. Now, if you pay off your credit cards, but you miss your auto loan payment, then don't come back and tell me that my score went down. It's if all things being equal, if you pay off your credit card debt, your score will go up. Your score will go up even further if when you pay off your credit card debt, you close just your youngest credit cards and you leave open that oldest one. Your score will go up even further. And again, having that strong credit score is an important factor in our daily lives, more than it has been in the past, and it'll continue to be important.
Yeah, that is so interesting. I had no idea about that myth, Jeremy. I really didn't. That's awesome to know.
Again, the people who are most invested in that myth being bought into are the ones that earn money on your interest that you pay on your
Yeah.
credit.
Interesting. Wow. Well, thank you so much. All of that wrapped in. If anybody has any questions, they can stop by any CapEd branch or give us a call, and we're more than happy um, to help with consolidating any debt and getting members closer to financial freedom. Along with that, too, if you want to look at your credit and what's on your report, you can go to annualcreditreport.com. Each person is entitled to 3 free reports every single year from each of the bureaus to see what's on their report. It's a good tactic to make sure everything's in line and in order and there's nothing out of the ordinary on there. Jeremy, do you have anything else to add before we go?
No, I think what you just mentioned to the listeners is important. Annualcreditreport.com gives you access to all 3 of your credit bureaus. The importance there is looking at the reports themselves and make sure that you don't have any fraud on your credit bureau. No one is applying for credit in your name and that the information is accurate. When you go into Savvy Money, which is the tool that we offer to our members, it is only displaying your TransUnion credit report. It doesn't show you all 3 bureaus. So that's a good important tip that Tyler just gave our listeners.
Perfect. Awesome. Well, I appreciate your time, Jeremy, and all our listeners really do appreciate all the information that you just gave. And I think it's really going to help all of us get out of that holiday debt.
Of course. Well, for everyone that's listening, happy holidays, happy new year, and thank you for being part of our podcast.
Yeah, thank you, everyone, and we appreciate your membership. Thank you, Jeremy.
Insured by NCUA, Capital Educators Federal Credit Union is an equal housing lender.